Welcome back. In this part of our video, we're going to apply some of the overall concepts that we learned in part one to actual examples. We'll start back with our friend Chipotle. And you may remember in chapter 2 and 3, we did some adjusting journal entries that affected Chipotle's financials. And this is the unadjusted trial balance that we had based on those entries we previously recorded. Remember that the point of an adjusting entry is simply to make sure that our debits equal our credits. I moved my recorder down so you could actually see that the debits do in fact equal the credits. That's the whole point of a trial balance. It's the only thing it does, is it makes sure that our debits equal our credits before we move on and create the financials. Before we create those financials, though, now with our new knowledge, we understand, hopefully, that we need to make some adjustments to our revenue and expense accounts. So that's what we're going to work on next. So here are some examples of the 4 different types of adjustments that we discussed. So the first one is an example of a deferred revenue. It says Chipotle received cash last period from customers purchasing gift cards. During the first quarter of 2018, the customers redeemed a portion of the gift cards for $52. So back in one of our previous chapters, probably chapter 2, we recorded this transaction where they sold the gift cards. And when we did, we're going to debit cash because we received the money, and then at that point we would credit unearned revenue because we haven't earned anything. Giving them a piece of plastic isn't what they're really paying for. They're paying for the food, so they won't get that until they turn in the gift card. So at the time in chapter 2, we received the money and recorded the unearned revenue liability. Now what's happened is we've earned a portion of those gift cards by providing $52 worth of food. So the first step is to say to ourselves, well, what happened to our accounting equation? I've earned something, so automatically your brain should go revenue. So revenue is going to go up. And then I've earned it, so I don't owe it anymore. So the first step is to think in terms of the accounting equation. And I always like to add revenue minus expense equals net income. So I've earned it, so 52 would go up in revenue, which makes net income go up 52, and in turn, that makes our stockholders' equity go up by 52. I don't like the way the textbook shows that revenue is affecting equity directly, because the way they present it makes some students believe that revenue is part of equity. Revenue affects equity, but revenue accounts don't show up under the equity section. So that's why I always like to expand my accounting model to include my income statement to make that distinction. So that's very important to keep into mind. Now that we've done the hard part, we know which accounts are involved and whether they go up or down. Now we just convert that to debits and credits. So when we do that, we're going to end up debiting the liability to make it go down and crediting the revenue to make it go up. If you did as I asked and you have your 4-quadrant summary that we created together, you'll notice that under deferred revenue, the original cash entry corresponds with the example I gave you above, and then the adjusting entry for deferred revenues does indeed involve a debiting to unearned revenue and a crediting to our revenue account. So the point of this is to adjust that unearned revenue account to its appropriate balance. So we had previously had a balance of 106 in our unearned revenue account. So that's from all the gift cards that were purchased in the past. And because now customers have redeemed 52, our remaining balance is the 54. So the whole point of the adjusting entry, this 52 adjustment, is to fix the balance to make it correct. That's why it's called an adjusting entry. We're adjusting the balance to make it correct. So we're adjusting our liability balance and we're also adjusting our revenue balance. The 1228 represents revenue that we previously recorded. We're adding another 52 that's now been earned to get our adjusted balance in revenue, which is this 1280. Remember, this isn't some magic that's going on in these T accounts. All we're doing is shoving our journal entry. So we had unearned revenue on the left. We shoved that on the left of the unearned revenue account. And then we have our revenue on the right. And we shove it on the right of our revenue T account. So that just allows us to figure out what the final balance is. With the unearned revenue, because we had a balance on the credit side and then an entry affecting the debit side, the way you add up a T account, remember, is add up your debits, add up your credits, and take the difference. And the difference of 54 goes on the credit side because the credits are bigger. For revenue, we had a beginning balance on the credit side plus an extra credit from the adjustment, so we just add those together. And again, the biggest balance and the only balance on this is the credit side, so that's where your balance ends up. It should make sense that your balance is on the side that it is, because the normal balance of an account should be on the side that makes it go up. Liabilities go up with credits, as do revenues, so both of those balances being on the credit side makes sense. Let's go through another example. Investments owned by Chipotle earned 1 in additional interest revenue for the quarter. So how are we going to record this? Well, this is an example of an accrued revenue. So it means we've earned it, but we haven't received it yet. So we'll start out with our accounting equation. If we've earned it, revenue gets recorded, which again, revenue minus expense equals net income. Our revenue goes up 1, which makes net income go up 1, and that's why our equity, specifically retained earnings, goes up by 1. And because we haven't received it, the other impact will be our assets, our interest receivable, would go up. So when we did our generic example, we said just receivable or account receivable. Any receivable would work, and because this is for interest receivable, that account would make sense. You won't have to choose between account receivable and interest receivable in any of the exam problems. Knowing it's a receivable is enough. Once we have the up and the down, then we do our journal entry, and this journal entry, lo and behold, will correspond with the one that you see in your summary, where we debit the receivable and credit the revenue. Why? Because assets go up with debits and revenues go up with credits. We already did the hard part when we thought of the ups and downs. Converting it to a journal entry is as simple as using our conversion guide that we've covered in chapter 2 and 3. The last step is to shove it in our T accounts. So if it's on the left, we put it on the left. So I guess I should use my journal entry up here to show it. On the left, put it on the left. On the right, put it on the right. And again, the goal is to adjust these balances and make them correct. I just realized there's a math issue here with the interest receivable balance. It shows a balance of 0 plus 1 does not equal 2. So I apologize that I didn't see that earlier. So the ending balance on that would be 1. Interest receivable or revenue, on the other hand, started with 1 as a balance. So when we add another 1, we do end up with a correct balance of 2 at the end. So again, the whole point of our adjusting entries are to fix the balances and make them correct at the end of the period. Let's move on to deferred expenses. So with deferred expenses, cash comes before the using of the expense. So examples are like supplies, buildings and equipment, we buy them before we use them, and then any other prepaid type of expense, which is anything that we pay before we use. So the first step is which or was an expense incurred and not yet recorded. Well, in our example here, at the end of the quarter, Chipotle counted 24 in supplies on hand, but the supplies account indicated that there were $390. So where did they go? We must have used them. So the answer to step 1 is yes, supplies were used, and we haven't recorded it yet. Step 2 is, was the related cash paid in the past, or will it be paid in the future? Well, if we bought the supplies in the past, the cash changed hands in the past. So we now need to make an adjustment to reduce those supplies. Compute the amount of expense incurred. Well, to do that, we're going to compare what we had in the past to what we have at the end. So the breakdown for supplies would be our beginning supplies, plus any purchases we made, and those balances would come from chapter 2 when we went over the purchase of supplies. So if we had 20, we bought 370. This is where the 390 in the problem up here comes from. So if we had 390 and then at the end of the period we have 24, the difference between what we had and what we have now is what we used, which is the amount of our expense. So the formula here should be logical. What I start with plus what I buy is what's available. then what's minus what's left over must be what's gone or what is used. So originally, when we made the purchase, we would have debited our supplies by the 370 when we bought those supplies, because assets go up with debits, and we would have credited cash by the 370 because assets go down with credits. That's not the adjustment. That would have been the original cash transaction. Remember, with deferrals, cash comes before. So then, how do we record the adjustment for the amount we used? Well, again, if we used it, an expense is going to go up, which makes net income and equity go down. And then, what did we use? Our supplies asset would also go down. So if I expand my model, revenue minus expense equals net income. I've used up some supplies, so I have an expense. Remember, expenses are simply a record of what's been used. That makes net income go down. Remember, parentheses means negative, and that in turn makes my equity on my balance sheet go down. What else goes down? The supplies. They're gone. So the asset goes down. To do my journal entry, expenses go up with debits, assets go down with credits, and that again would correspond with the 4 quadrants. If you look under deferred expenses, we debited expense and credited an asset. In this case, the asset we're using is supplies. That's our prepaid. We don't call it prepaid supplies. We just call it supplies, but effectively that's exactly what it is, a prepaid supply. You paid for it before you used it. So then the last step is to post. So if it's on the left, we put it on the left. If it's on the right, we put it on the right. And the overall goal is to fix the balance and make it correct. And you'll notice that in the supplies account, our adjustment does in fact make the balance correct. It was $390, we used up $366, so at the end of the day, the adjusted or corrected balance is that $24, which it said in the problem was the amount on hand. So that further verifies that we've done our adjustments correctly, because the ending balance is what the problem told me it should be. Adjusting entry 4 deals with another example of a prepaid expense. It said the prepaid expense unadjusted account balance of $131 includes $72 paid at the beginning of the quarter for rental facilities at $18 per month, $48 for insurance covering 6 months, and $4 for advertising during the quarter. So was an expense recorded or incurred that wasn't recorded? Yes. Part of the rent and insurance and advertising have been used up. So now we need to record the amount that's been used. Was the cash paid in the past, or will it be paid in the future? It was paid in the past. We prepaid the rent, insurance, and advertising before we used it. So then we have to figure out how much has been used. Well, if the rent is $18 per month and 3 months have went by, this is where using your fingers would be helpful, then we know we've used $54. How do we know how many months have went by? It says in the problem that 72 was paid at the beginning of the quarter. A quarter is 3 months. So that's where the 3 comes from. We must have paid for it at the beginning of the quarter. If it was the last quarter of the year, that would be October 1st. So October, November, December, using my fingers, that's 3 months that have went by. So 3 months at 18 a month is where the 54 comes from. The insurance is 48, and that was for 6 months beginning on January 1. So this must be the first quarter that we're doing, not the last, like I had thought. So if we paid 6 months on January 1, the best way to do it in my mind is to take the 48 divided by 6. That'll tell you the monthly amount, and then multiply by the number of months that went by. And in the first quarter, January, February, March, there's 3 months that went by, and that'll get you to the 24 that was used. So whenever I'm doing it, I always say, what's the total amount? And then I divide it by the number of months that that total represents, then multiply it by the number of months that have went by. That's the easiest approach. The way the book shows us to do it, they say, well, 3 months are in the quarter, 6 months is the coverage, so they divide 3 over 6 to basically tell us we've used up half. Either way, you arrive at the same $24. And then the advertising was $4 for the advertising in the quarter, so because the quarter is over, the entire 4 has been used. So because we keep saying that rent, insurance, and advertising is used, that means we have an expense for all of those items. So to record our adjustment, we start with our accounting equation. We have revenue minus expense equals net income. We have a total amount of expenses of 82, which is made up of rent of 54, insurance of 24, and advertising of 4. That makes net income go down 54, 24, and 4. Which in turn makes equity go down by all of those amounts. And then our individual prepaid accounts also are going to go down because we've used them up. So our adjusting entry is going to involve a debit to all of those expense accounts and then a credit to our prepaid expenses. Because we debit expenses to make them go up, and because we've used up the prepaid, we credit the prepaid account to make it go down. Then we post to all of our T accounts to adjust the balances. If it's on the left, we put it on the left. So we have our rent expense, our insurance expense, and our advertising expense all going up, and then our prepaid going down. So when all is said and done, the adjusted balance in the prepaid account is $49. That means that we still have $49 remaining of future benefit, which we'll use up or expense in the next quarter. Another example of a deferred expense would be long-term assets. Remember, we purchase long-term assets and then we use them up over time, and that using up over time is referred to as depreciation. It's the systematic allocation of the cost of the long-term asset over its useful life. So was an expense incurred? Yes, we've used up part of the buildings and equipment for the quarter, and we haven't recorded an expense. Was the related cash paid in the past, or will it be paid in the future? It was paid in the past when we bought the buildings and equipment. Compute the amount of the expense. Well, at this point in the game, we're not going to go through the calculations to compute depreciation. We'll just give it to you. So 124 for the year, it's given. We'll have a later chapter that'll cover how to calculate it. And then 1/4 of the year has gone by because, again, each quarter of a year is a 1/4. So 31 is the amount of depreciation we need to record for the quarter. What has happened under our accounting equation? Well, we've used the buildings and equipment up, so we need to record an expense under our accounting equation. So expenses go up to 31 that's been used up, which makes net income go down 31. And again, whatever happens to net income happens to our equity. What's a little funky about this is, yes, our assets did go down, but we don't decrease the buildings and equipment directly. Instead, we use this count called accumulated depreciation. It's a contra asset, which means it's a negative asset. The reason we do this is we want to know how much was originally paid for the buildings and equipment versus the amount that's been used up. So in the buildings and equipment account, it would show the amount that we paid for those assets. In the accumulated depreciation account, it shows the amount that we've used up over time. The reason we want to do this is because if a company has buildings and equipment that they paid $1,000 for, and the accumulated depreciation, which is a negative asset, is $990. The book value, which is what's left over, is $10. But if we also had a company that had $100 in buildings and equipment and they had used up $90, the book value would also be $10. But these two examples are far different. One company has far more assets that have been used up, almost down to zero, And the other example is a company that has far fewer assets that, yes, it's been used up primarily down to the same $10, but when they use it up down to zero, they're going to have to replenish $100 worth of assets, whereas the first example is going to have to replenish 1,000. So we want to provide the users with useful information to make their decisions. So we want them to know how much was originally paid for the assets versus how much has been used up versus how much has been left over. So the buildings and equipment account would be how much has been purchased. The accumulated account, the contra asset, is how much has been used up. And the book value is the difference. It's the amount that's left over. So again, the whole point of this is just to provide more useful information to decision makers. Do our journal entry. Expenses go up with debits. So we debit the depreciation expense. And then assets go down with credits. So we're going to credit that accumulated depreciation. It is a contra asset, so crediting it makes it go up because it's the opposite of an asset. Assets go up with debits. Contras go up with credits, the opposite. But if that hurts your brain, forget it. What happened to our assets? We've used up our assets. Assets go down. How do you make assets go down? With a credit. So that supports the fact that we credit the asset-related account. You have to remember that it's called accumulated depreciation. We don't directly credit the buildings and equipment. So that one's a little tricky. It doesn't perfectly fit in to our quadrants, but very close. So with a deferred expense, we said the adjustment is debit the expense, credit the prepaid account. Instead of crediting prepaid equipment, we use the accumulated depreciation account. So you got to remember that little nuance. Then we post it. Let me erase my writing here so you can get a better view of our posting. We can see the depreciation expense is going up by the 31, and then our accumulated is also going up by 31, but because it's a negative asset, it makes assets go down. And this 1010 balance would be the total amount of my long-term assets that I've used up since I purchased them. Moving on to our final example, accrued expenses. Many expenses are incurred during the current period but haven't been paid yet, so we're going to pay for them after. That's what makes them an accrual. Wages, utilities, and interests are some common examples. These accrued expenses accumulate over time but are not recognized as expenses till the end of the period in an adjusting entry. Remember, we don't want to recognize this stuff daily. It takes too long and it'll be too costly. So let's go through our steps. We have an example here. Chipotle employees earn $67 in wages for working 2 days at the end of the quarter, and they're going to be paid next quarter. So was an expense incurred? Yep, we used up our employees. Did we pay it? No, not yet. So we owe the money, and then the amount of the expense is the $67 that we owed the employees. So to record our adjustment, we first think in terms of A equals L plus E. We've used the employees, so we have to record an expense for the amount we owe them, $67, which makes net income go down and equity go down by that amount. And then we haven't paid them, so we have a liability, wages payable, which also is going to go up because we owe them more money. Converting that to debits and credits, we debit the expense and credit the liability because that's what our conversion guide tells us to do. And then we post. So if it's on the left, we put it on the left, which increases our overall wage expense. And then if it's on the right, we put it on the right, which increases our wages liability. Should make sense. We've used employees, so we have an expense, and we owe them, so we have a larger liability. Again, this fits in with our 4 quadrants. If you look at accrued expenses, the generic entry was debit an expense and credit a liability. Another example is interest. For interest, you need to know how to calculate it. And to calculate it, it's the principal of the loan times the interest rate times the number of months outstanding over 12. That's what this fraction of a year is. Number of months outstanding divided by 12. Here's a hint, don't ever mess with my 12. There's 12 months in a year, there'll always be 12 months in a year, so don't ever change the 12. It doesn't matter if it's a 3-month loan, a 6-month loan, an 8-month loan, a 10-year loan, it's always out of 12 because we're trying to figure out our annual interest for the part of the year that's went by. Because we're dealing with a year, there's always 12 months. So Chipotle had a balance of 78 in their long-term payable. That would be the principal amount. And they borrowed an additional 2 at the beginning of the quarter, so I jumped the gun. They have a total amount of the loan principal of 80. The interest rate is 5%, and the number of months outstanding, because it's 1 quarter, would be 3 months out of 12. And that would get us our interest for the period. So if we do out the math, we're going to end up with $1 in interest. And then how does that affect our accounting equation? Well, we've used up the interest, so we have an expense, and then we haven't paid it yet, so we would have a payable. So expanding my accounting equation, revenue minus expense equals net income. We have an expense of 1, net income goes down 1, and that's why our equity goes down 1, and then we haven't paid it yet, so we have a payable. So just like our last example, our adjustment is going to involve a debit to an expense, in this case interest expense, to make it go up, and a credit to our liability because liabilities go up with credits. Again, think in terms of up-down, then use your conversion guide to convert it. When we post it, if it's on the left, we put it on the left, so our interest expense go up. If it's on the right, we put it on our right, so our interest payable also goes up. Now we have utilities. Chipotle received a utility bill for $15 for usage during the quarter. The bill will be paid next quarter. So was an expense incurred? Yes, we used the utilities. Did we pay for it yet? No, it'll be paid in the future. What's the amount of the expense? It's the $15 we used. So the first step is to think of our accounting equation. We've used it, so we have an expense. We haven't paid it, so we have a payable. So under our accounting equation, we're going to see that we have our expense going up. Again, I'll expand my model to include my income statement here. Expenses go up because we've used them. That makes net income go down, and therefore our equity go down. And then we haven't paid it yet, so we owe more, so our liability would go up. To convert that to debits and credits, expenses go up with debits, liabilities go up with credits, just like the other accrued expense examples that we've done. And then we finally post it to adjust the balances, so our expense goes up by the extra $15 from that final bill we received, and then our liability goes up by the $15 because we owe an additional $15 to pay off that amount we've used up. Finally, we have income taxes. So a final adjusting entry to record an accrual of $101 in income taxes that is going to be paid next quarter. So after we get net income, we take some percentage of that, and that would be how we'd calculate the income taxes. In this example, they just gave it to us. But again, was the expense incurred? Yes. Did we pay for it yet? No, we're going to pay for it in the future. How much? 101. So this is just like the other examples. So in our accounting equation, we're going to have an expense go up because we've used up the income tax. So all you have to do to use up income tax is make income, and the IRS comes in and takes their piece of the pie. That makes net income go down, and in turn my equity go down, and then I haven't paid it yet, so my liability would go up. Just like the other accrued expenses, debit the expense and credit the liability is all we need to do. Expenses go up with debits, liabilities go up with credits. And then post, if it's on the left, put it on the left, increasing our expense. On the right, put it on the right, increasing our income tax liability.